If you've been anywhere near the news lately, you've probably seen the headlines about Bitcoin's price. It's been a bit of a roller coaster, right? One day it's up, the next it's dipping. Kind of feels like a market stuck in neutral. Okay, let's unpack this. Today, we're doing a deep dive into the very latest Bitcoin intelligence briefing. And it paints a really interesting picture, a market that's, yeah, certainly in a period of consolidation, but with some surprisingly robust foundational growth happening just beneath the surface. Our mission here is really to look beyond those immediate daily price numbers and truly understand the underlying shifts, the true drivers, and what these developments might mean for Bitcoin's long-term trajectory. We're going to explore where some of that immediate fear is coming from, and importantly, where the growth is quietly building. So to set the stage for where Bitcoin is right now, the briefing describes this contested range. It's essentially this tense tug of war where the bearish and bullish pressures are really battling it out. We've seen Bitcoin trading in a pretty tight range, generally hovering around that $114,000 mark, give or take. And with a slight dip, what's that, around 2.5% in just the last 24 hours? So the big question is, what's driving this current push and pull?
Well, yeah, if you're wondering about the why behind some of that recent price weakness, a primary factor has been pretty substantial withdrawals from spot crypto ETFs. Those investment vehicles that let you trade Bitcoin like a stock on traditional exchanges.
Right, the ones that launched earlier.
Exactly. Over a brief 3-day period, we actually saw combined outflows from both Bitcoin and Ethereum ETFs getting close to $1 billion.
$1 billion? Wow.
Yeah. And the selling pressure really ramped up on one specific day spot. Bitcoin ETFs alone recorded over $500 million in net outflows just in one day.
Okay, that's significant selling pressure.
It is. And this institutional de-risking, it introduced a considerable amount of supply into the market. It even pushed the broader market sentiment, the fear and greed index, firmly down into fear territory. I think it hit 44. But what's truly illuminating here, I think, is the distinction that's emerging between what we might call fast money and slow money. These rapid ETF outflows. They're characteristic of fast money. Think hedge funds, tactical allocators.
People making short-term plays.
Precisely. They're using these liquid instruments for quick positioning. But that's quite different from slow money. That represents your strategic, long-term allocators like, say, state pension funds. And the crucial point the briefing makes is that 71% of institutional investors now hold digital assets.
71%? That's huge.
It is. It suggests that the core long-term institutional thesis for Bitcoin remains intact, even if some tactical players are taking profits off the table right now.
Okay, so the short-term traders are reacting, but the long-term conviction might still be there.
That seems to be the picture. Now, if we shift our focus to the on-chain data, we get an even more nuanced view. It's like seeing beneath the surface. The briefing reveals what it calls a capitulation event among short-term holders.
And those are people holding Bitcoin for less than, 5 months?
That's right, less than 155 days.
Yeah.
Since Sunday, over 20,000 Bitcoin held by this group were actually sold at a loss.
At a loss. Ouch.
Yeah, it indicates that newer, perhaps less convicted market participants have been shaken out by this recent volatility. But here's the real kicker.
Okay.
During the exact same period, Bitcoin whales, these are the large, high-conviction holders, they accumulated an identical amount, over 20,000 BTC.
Wow, identical, so a direct transfer, almost.
Near perfect symmetry. It's not coincidental. It's the direct on-chain footprint of what's often called a wealth transfer from weak hands to strong hands.
Boy, I've heard that term.
And this dynamic, it's frequently seen as a healthy market cleansing during a bull market correction.
Like a spring cleaning for the market?
Kinda, yeah. It removes some of that speculative froth and concentrates more of the circulating supply into the hands of entities less likely to sell just because the price dips.
Yeah.
So you could argue it's the market actually getting stronger for the next phase, not falling apart.
Okay, that makes sense. Whales accumulating while shorter-term holders sell off. And that tug of war we mentioned earlier, it's really reflected in analyst sentiment right now, isn't it? Expert opinion seems sharply fragmented on Bitcoin's immediate path. You've got one camp seeing the recent price bounced from around, $112,400 as a sign of robust dip buying demand. From their perspective, this correction is just necessary, healthy consolidation, as long as those key support levels hold.
Right, the bullish view.
But then, conversely, you have a more bearish group sounding alarms. They're pointing to the break of a crucial 5-month-long ascending trend line that's a key technical pattern suggesting an uptrend might be ending.
A technically significant break, yeah.
And some forecasts are even suggesting a potential move below $60,000, though that's looking out towards 2026. This caution is also echoed by some automated technical summaries, which are apparently flashing a strong sell signal based on moving averages.
Which track trends over time, yeah.
It really underscores the uncertainty of this moment, doesn't it? Different analysts looking at the same charts and seeing very different things.
Absolutely, a contested range indeed.
So that's the market's immediate push and pull. But beyond these day-to-day moves, what about those foundational shifts? The things underpinning Bitcoin's longer-term strength? Let's maybe turn our attention to what's happening in the regulatory landscape, because that's where we seem to be seeing some really significant changes.
Exactly. Beyond the price noise, a really significant development is this global shift away from regulatory uncertainty towards, well, tangible legal frameworks. And this trend, which we've seen accelerating even just the last 24 hours, is overwhelmingly positive for long-term institutional adoption. It gives that much-needed clarity.
Yeah, clarity reduces risk for those big players.
Precisely. It significantly reduces the perceived risks for traditional financial institutions looking to get involved.
And we're seeing some genuinely pioneering moves right here in the U.S. that really highlight this shift. Take Wyoming, for instance. In what looks like a landmark development, the state has launched the Frontier Stable Token, or FRNT.
FRNT, okay.
This isn't just another crypto coin. It's the nation's first state-issued dollar-linked digital currency.
State-issued. Interesting.
Yeah. Well, fully backed by cash and short-term U.S. treasuries, apparently with an extra 2% reserve for stability. And it's designed to work across 7 major blockchains through a partnership with Layer 0 that's tech that lets different blockchains talk to each other.
Interoperability, right.
Exactly. It feels like a major step in legitimizing and integrating digital assets into government financial structures, maybe setting a model for other states.
Potential blueprint here.
Now, on a federal level, we've also seen a pretty quiet but potentially significant shift from the U.S. Federal Reserve. They've announced they're shutting down a special supervision program that was focused on how banks engage with crypto.
The Novel Activities Program from 2023.
That's the one. It was designed to scrutinize banks' involvement with crypto and blockchain. Terminating it signals a policy shift. It effectively reduces some procedural hurdles for regulated banks looking to engage more deeply with digital assets. Less friction.
That's a subtle but important signal from the Fed, lowering the barriers. And if we connect this to the bigger picture, these U.S. developments are actually unfolding alongside a really unique geopolitical dynamic. Reuters recently reported that Chinese authorities are actively considering authorizing yuan-backed stablecoins for the first time.
Yuan-backed stablecoins, okay, that's big.
It is, and the reported strategic reason is to promote the global use of the yuan and, critically, to counteract U.S. advances in stablecoins.
So it's framed as direct competition.
Explicitly. This positions the stablecoin arena as a new front in that broader geopolitical and economic competition between the U.S. and China. China framing its potential stablecoin as a challenge to U.S. dollar dominance is a direct external pressure. And simultaneously, you have Wyoming's state-issued FRNT token, which represents an internal decentralizing force, moving dollar-based digital currency issuance away from being purely federal or private sector.
Interesting dynamic. External and internal pressures.
Exactly. Together, these forces create a sort of pincer movement on the singular dominance of a single federally backed or U.S. corporation-issued digital dollar.
Okay, I see the pincer idea.
And this increasingly competitive, maybe even fragmented landscape of sovereign digital currencies. Well, it really enhances the appeal of a truly neutral, non-sovereign, globally recognized digital asset.
Like Bitcoin.
Like Bitcoin. For central banks, corporations, individuals seeking a hedge against risks in this new era of currency competition, Bitcoin's value proposition as a neutral reserve asset is significantly strengthened by all this.
That's a fascinating take. The competition actually makes Bitcoin more appealing as a neutral ground.
Potentially, yes.
And it's not just the major global powers playing this game, is it? Nigeria, for instance, a country with huge crypto adoption already. They're taking pretty decisive action, too, trying to create a regulated, secure market.
That's right. Their SEC, the Securities and Exchange Commission, is actively implementing its Comprehensive Investment in Securities Act, ISA 2025.
Okay.
This legislation formally defines crypto assets under securities law. It mandates licensing for VASP as virtual asset service providers.
So requiring exchanges and others to get licensed.
Exactly. And it introduces severe criminal penalties for fraud. They're directly responding to things like the estimated $1.3 billion Cybeg scam that hit investors hard there.
Oof. Yeah, trying to prevent repeats of that.
The goal seems clear. Not to stifle Nigeria's vibrant crypto economy, which involves, what, over 33 million users,
Wow.
but to foster trust and help those users distinguish legitimate operators from bad actors, create a more sustainable environment for growth.
Makes sense. Build trust, build the market properly. So that regulatory clarity is clearly paving the way. But how is this actually translating into tangible adoption in the corporate world, in traditional finance? Are we seeing capital flows diversify beyond just those ETFs you mentioned earlier?
Absolutely. And we got a strong signal of mainstream investor confidence just recently from the public markets. The IPO of Bullish Confident, the operated crypto exchange and owned CoinDesk, it was pretty successful. Shares opened significantly above the IPO price last week.
Okay, a successful crypto-related IPO. That's a good sign.
It is. But what's particularly compelling here is how they handled the proceeds. Bullish announced it arranged to receive over $1 billion of its IPO proceeds in stablecoins.
A billion in stablecoins.
Yes, mostly minted on the Solana network.
So using blockchain rails for major corporate finance.
Exactly. It genuinely merges traditional public market infrastructure, the IPO, with blockchain rails. A novel and pretty efficient use case for stablecoins in big corporate finance operations.
That is interesting. And it's not just crypto companies, right? Are traditional corporations starting to put Bitcoin on their balance sheets too? I saw something about a Japanese firm, House.
Yes, that's another key example. The Japanese conglomerate House announced they acquired 17.51 bitcoins for their corporate treasury, valued around 300 million yen.
Okay, maybe not a huge amount in the grand scheme, but significant for a traditional company.
Right. The absolute size isn't the main story. It's the strategic framing. The company explicitly called this acquisition a proof of concept or POCHI initiative.
A POCI, so like a test run.
Exactly. They'll use this POCHI to evaluate and potentially develop a broader cryptocurrency management system for the firm. It's a cautious, exploratory first step, very common for more conservative corporations entering a new asset class, and it can certainly foreshadow a larger wave of corporate treasury adoption in Japan.
Dipping a toe in the water, potentially leading to a bigger dive later.
Precisely. And this diversification of capital isn't just limited to public companies either. There's a distinct trend emerging among affluent families and private family offices, particularly in Asia. They're reportedly increasing their allocations to crypto quite significantly.
The family offices are getting in. That's usually considered smart, patient money.
Traditionally, yes. And this capital flow from a typically risk-averse investor class is being driven by a few things converging. The ongoing bull market, sure, but also growing mainstream acceptance and, crucially, those clearer regulatory frameworks emerging in the region.
Back to regulation enabling adoption.
It's a key piece. The participation of this cohort suggests a growing perception that digital assets have matured, they've de-risked enough to be considered a viable part of long-term wealth preservation and diversification strategies.
Okay, so let's tie this together. What does this all mean for you listening? These events, when you look at them collectively, they really illustrate the maturation of a multifaceted system for capital to flow into digital assets.
Yeah, it's not just one pipe anymore.
Right. Capital is now entering through distinct parallel channels. You've got public equity markets via IPOs like Bullish. You've got direct corporate treasuries like House. You've got private wealth management for high net worth families. And all this is in addition to the established spot ETF channel.
Different doors for different types of investors.
Exactly. Each of these pipelines caters to a different investor type with unique risk profiles, different regulatory needs. And this diversification makes the ecosystem's financial foundation far more robust, doesn't it?
It should. Unlike in previous cycles where the market might have been heavily reliant on just one or two narrow on-ramps.
Like maybe just retail buying or just early VCs?
Right. Today's diversified capital pipeline means that a temporary slowdown in one area, like the current ETF outflows we discussed, can potentially be offset by continued strength and inflows from others.
Leading to a more stable, more mature market structure overall, less fragile.
That's the idea. More resilient.
Okay. And speaking of maturation and real-world utility, we absolutely need to talk about a critical development in Bitcoin's Layer 2 scaling solution, the Lightning Network. This feels like a big one, moving from theoretical potential to practical, real-world application by a major regulated financial institution.
This is truly a watershed moment, I think.
Mm-hmm.
SoFi Technologies, a well-known U.S. bank, is set to become the first U.S. bank to integrate the Lightning Network for international remittances.
The first U.S. bank, wow, for remittances.
Yes, it's a groundbreaking initiative done through a partnership with Lightspark. It will allow SoFi's, 11.7 million members to send low-cost, near-instantaneous cross-border payments directly from their mobile app.
Near instant and low cost. That's the promise of Lightning.
That's the core value prop. The service will launch initially for the U.S. to Mexico corridor, which is a huge remittance channel.
How does it actually work?
Well, the mechanism basically involves converting U.S. dollars to Bitcoin, transmitting that value across the Lightning Network in seconds, and then converting the Bitcoin back into the recipient's local currency, pesos, in this case in real time.
Seamless for the user, presumably.
That's the goal. And this move directly challenges the multi-hundred-billion-dollar global remittance market, which, as you know, has long been dominated by legacy players with higher fees and much slower settlement times.
Taking on Western Union and the like.
Potentially, yes. It's a major validation for Lightning.
Now, this news about SoFi integrating Lightning, it comes amidst a seemingly contradictory data point I saw. The public capacity of the Lightning Network, measured in Bitcoin locked in public channels, has actually declined by a notable amount this year, hasn't it? Down like 20% or something.
That is correct. The public capacity figure has dropped from around 3,400 BTC to about 4,200 BTC in 2025.
So less money publicly locked in Lightning. That sounds bad.
It sounds counterintuitive, right? But this is where a deeper analysis reveals it's actually a misleading metric for the network's overall health and utility.
Okay, how so?
Well, first, real-world usage is demonstrably growing. For instance, a major exchange like Coinbase now routes about 15% of all its Bitcoin withdrawals via Lightning. That's volume.
15% is quite a bit.
It is. Industry experts attribute the decline in public capacity not to falling usage, but actually to technological maturation.
Maturation causing capacity to drop. Explain that.
Okay, so a couple things. One is the consolidation of payment routing through larger, more professional hub operators. They might use private channels more, which wouldn't show up in that public figure. Second is the adoption of protocol enhancements like channel splicing. This allows for dynamic resizing of payment channels without needing costly on-chain transactions. It leads to more efficient use of liquidity, so maybe less total BTC needs to be locked up publicly for the same or even greater payment volume.
Ah, okay. More efficient use of the capital locked up.
Exactly. And furthermore, there's another big factor. The recent integration of stablecoins, like Tether, USDT, onto the network via something called taproot assets.
Right, issuing other assets on Bitcoin's layers.
Yes. This decouples the network's payment volume from its raw Bitcoin capacity. You can send billions in stablecoin value, potentially using relatively little underlying Bitcoin capacity for routing.
I see. So the utility as a payment rail can scale even if the amount of BTC locked doesn't grow linearly.
Precisely. The utility scales independently now. So looking only at public BTC capacity gives an incomplete, even misleading picture.
Got it. That context is crucial.
And importantly, SoFi's adoption here isn't happening in a vacuum. It's a direct beneficiary of that improving regulatory climate in the U.S. we talked about earlier.
How so?
Well, think about it. A publicly traded, regulated U.S. bank like SoFi operates under intense scrutiny. They simply couldn't integrate a novel technology like Lightning if the regulatory environment were prohibitively ambiguous or hostile.
Too much risk for them.
Exactly. The Federal Reserve shutting down that burdensome supervision program for novel activities. That's a concrete example of the regulatory thawing that enables a move like SoFi's. It lowers both perceived risk and operational friction.
Okay, so it creates a feedback loop.
A symbiotic feedback loop, yes. Regulatory progress acts as a direct catalyst for Layer 2 innovation and adoption by mainstream players like SoFi. And as the rules of the road become clearer, it's likely we'll see an acceleration in similar integrations from other banks, other fintech companies.
Creating a powerful self-reinforcing cycle. Policy clarity drives tech adoption, which encourages more policy clarity.
That's the dynamic we seem to be entering.
Okay, so let's try to synthesize everything we've covered today. The last 24 hours or so in the Bitcoin market really show this period of consolidation, right? Short-term price action is clearly influenced by that tactical institutional trading reflected in those significant ETF outflows and the resulting fear in retail sentiment. This has definitely created a period of, well, necessary price discovery above those critical support levels. Finding a floor, maybe?
Agreed. That's the short-term picture. But on the other hand, the long-term fundamental thesis for Bitcoin has arguably been significantly reinforced by this series of landmark developments. The regulatory landscape is maturing, moving from ambiguity to action. We see U.S. federal agencies reducing friction for banks, state governments actively building on blockchain.
Like Wyoming?
Exactly. The institutional and corporate capital pipeline isn't just widening, it's diversifying. That insulates the market from over-reliance on a single entry point, like just ETFs.
More pillars supporting the structure.
Well put. And finally, perhaps most significantly for its long-term utility, Bitcoin's primary scaling solution, the Lightning Network, has achieved a major breakthrough integration with a U.S. bank. It's transitioning from niche tech to a viable tool for mainstream finance.
A huge validation step.
It is, which raises an important question. What should you, the listener, really be monitoring going forward? The key indicators probably aren't the daily price fluctuations within this current range.
Don't obsess over the tick by tick.
Right. Instead, the real measures of future value are likely the continued progress in those regulatory frameworks, the expansion and diversification of that capital pipeline from TradFi, and critically, and all of these foundational elements saw material, positive progress just in the last 24 hours. They'll likely dictate Bitcoin's long-term trajectory far more than short-term market sentiment.
Focus on the foundations, not just the waves on the surface.
That would be my takeaway.
Okay, so here's a final provocative thought for you to mull over. In a world where we're seeing governments, major corporations, even U.S. states actively competing to issue their own digital currencies, what does all that mean for a truly neutral, non-sovereign asset like Bitcoin? Could its ultimate value proposition turn out to be less about just speculative gains and maybe more about its role as the ultimate hedge against an increasingly fragmented and frankly politicized global financial landscape? Something to think about. We really hope this deep dive has given you a clearer picture of what's truly happening beneath the surface noise of the Bitcoin market right now. It's definitely a complex landscape, but also one that's clearly brimming with innovation and these really important foundational shifts. Keep exploring, keep asking questions, and we'll be here to unpack the next big thing.